G'day everybody, Max Wright here from BitShares TV, and I have with me Dan Larimer, founder and lead developer of the BitShares platform. Now Dan, recently you wrote an article about how you're seeing a shift, or you hope to see a shift, with regards to crowd sales, and you made the case for that on one of your blog posts. Could you maybe just share with us your kind of vision there and what you expect to take place in that area?
I recently did a blog post calling for an end to crowd sales of cryptocurrencies, of crypto projects in general. This is primarily out of practicality and utility and tax consequences and legality. There is a lot of uncertainty around all of the crowd sales that have been going on. People have tried many different approaches for crowd sales. Some are very blatant. You've got the master coins that directly sold. They were one of the first that sold their master coin for Bitcoin and allocated them that way. You have BitShares, which didn't promise anything except donations. We accepted contributions with no strings attached. We can do whatever we want. And then you've got Ethereum. They did a crowd sale. They were selling the token necessary to power their gas in their virtual blockchain-based computer. All of these different approaches have their own pitfalls. Some of them are generic pitfalls for any crowdfunding, even traditional, through things like Kickstarter, that people might not be aware of. One of the biggest things that I've like to warn people about is don't raise money in December. If you raise money in December and don't pay it off by the end of the year, you have to pay up to a third of everything that you've received in taxes before you even start your project. And if it's a Kickstarter type thing where the money's held in escrow, you might not even have the money necessary to pay your taxes. Fortunately, with cryptocurrency, we don't have that problem exactly. In the case of BitShares, we raised a lot of money when Bitcoin was at $800, $850, and we held it in Bitcoins over the course of the year as it slowly fell to $300. That resulted in a large capital loss for our project, but according to tax laws, we owe taxes at the value it was that we received it. If you're not careful, you could end up owing more in taxes than the cryptocurrency is currently worth. So, there are a lot of issues there. And then there's the whole security issue. Are you selling shares in your company? I do not recommend selling shares in any company without SEC approval. It doesn't matter what country you are in. If you are trying to raise money with US citizens as people that are contributing, the SEC has a way of getting out there. So there are a lot of concerns. You end up owing people something. That's one of the things I've been trying very hard to avoid, is ever being in a position where I owe anyone anything. That's why I have donations. I want it to be free to disappear with the money with no obligations to anyone at any time. People gave us huge amounts of donations because they believe in my vision, and they believe that I believe in my vision, and that my vision is more important than the money I received. So they were willing to trust me that I would take the money I received and spend it on things to further my vision, which shared with them. But you don't want to be in a situation where you are creating a liability. A pre-sale, which is what Ethereum did, also creates a liability. If you don't deliver your token and you did a whole bunch of pre-sales, you're now on the hook for potential fraud accusations. And that is a real challenge. So all of the crowdfunding approaches that have been tried in the past have their own unique challenges, both from a tax perspective, a legal perspective, and even an IOU perspective. But with BitShares, we have an alternative approach that is far more friendly from both a tax perspective and a regulation perspective. And this is the concept of launching what we call a proto-chain, a proto-DAC. It's creating a new cryptocurrency, a clone of BitShares, if you will, that allows the initial stakeholders to vote in as 101 individuals to contribute to the project. They can start trading immediately, and the people that get paid, they're paid over time, so you don't have to worry about a large pool of funds in the developer's hands that could get hacked, stolen, or they just run away with. And you can change management as necessary. The people who hold the tokens can vote in new people to get paid. So the project can succeed without any one individual person. And the benefit is that because it's on a blockchain, and because delegate pay is just like miner pay, the legal considerations are identical to launching an altcoin with mining rewards and becoming a miner. Instead of mining with your computer, you're mining with your labor to help support the vision of whatever project it is that we're working on.
Okay, so let's maybe go through an example is probably the smart way to do this. And as we go through it, let's be mindful of the fact that BitShares was specifically designed to be what Bitcoin is for currency, BitShares is for business. And so all the tools that you're talking about are a way for blockchain to manage businesses. So with that lens, why don't you walk through with us exactly how a crowd sale on a BitShares blockchain might look?
I'm going to use the example of how Ethereum could have done their crowd sale differently.
Okay, and just by the way, this could apply to MaidSafe or Mastercoin, BitShares, any of them.
Right. It applies to us, applies to everyone. Ethereum could have taken the BitShares code, created and launched a network, just like they do with altcoins all the time, and then given each of the developers a position in the network and start paying them immediately with their Ether tokens in the system. Once the chain's out there, it can now be listed on all kinds of exchanges. So when the developers actually need to get paid, because they have to feed their family, they sell the tokens they earned from their paid positions with the blockchain in order to fund their family. The expenses, their food, shelter, and clothing, they get paid by selling it on the exchange. What this does is, at no point in time is there an IOU in the system. At no point in time is there a legal obligation between any two parties. As long as people believe in the project, the tokens themselves will have value, and the developers will be able to sell them in order to cover their expenses. Compare this to a pre-sale, where all the money, they're selling the tokens at auction in one lump sum and taking all the money and put it in centralized hands. And then they dole out the funds they received to the developers. All you did is remove the need for the developer to sell the token themselves. And in the meantime, you put this middleman, and you sold all your funds, all your tokens up front before you had a product, before people even knew what it was worth. You got the lowest possible price you could have gotten for those tokens. The developers could have, this project as a whole could have raised more money for the same number of tokens by paying it out over time versus taking it all up front without any of the legal risks.
Has anybody already done this yet?
As far as I know, the Sparkle clone of BitShares is planning on funding its growth through paying delegates and doing a 100% drop on the BitShares user base through AGS, PTS, and BTS. So that's an example of a developer creating something, not doing any pre-mine, although a pre-mine is also a pre-allocation, as I like to call it, is also a viable approach. And giving it away, hoping to see if the project can grow and sustain itself. If the tokens have value, we'll be able to hire people, reward the people that are contributing to the project, and it will take off and grow on its own. It's kind of a new concept. BitShares itself is continuing to use this process to fund growth. Our initial crowd sale got us enough money to get the system built, get something usable out there in the hands of people, prove it works, but to go from, hey, it works, to something that can compete with all the other exchanges with the Ripples of the world, requires a lot more money than just what you can raise in a single crowd sale from when people don't know you, you don't have a proven track record, and it's no strings attached. Now BitShares can fund $3 million a year at today's market cap, and if we are successful at growing and enhancing the value, then our budget will increase and we'll have greater spending authority thanks to the shareholders being willing to dilute to fund growth. And that is the key to these systems, is that you can have long-term sustainability without having to trust someone to ration out funds over time. What happens when Ethereum runs out of money? How does it continue to pay for development? Accept donations? And that is the real question that people need to look at, is how do you sustain these things long term?
So it seems to me there's another pretty significant challenge with crowdfunding that has been solved. In that crowdfunding gives you an initial hit of money, but then once that money has expired or used, then where do you go for funds? Because especially in the world of altcoins and cryptocurrencies, the tokens have been issued. You can't go back and all of a sudden reissue more. So let's talk a little bit about how what you're suggesting will actually provide the funds for long-term into infinity growth and development.
Sure. The BitShares network encountered this exact problem. We raised a couple $1 million, hired a bunch of developers, proved the concept, and then it became clear that, well, we're not going to have enough money to fund for the next 5 years that it takes to mature a product to the point where Bitcoin is today. That's why we added delegate pay, delegate dilution with limits. Right now, even at its maximum rate, the BitShares network dilutes less than Bitcoin pays for mining. So it's not that much of a load on the network, but it does give us the ability to fund development at a rate of $3 million per year at today's market cap, and if we are successful, it raises it over time, proportional to the market cap. This gives projects long-term sustainability and predictability. You don't have to worry about your development funds getting seized and all of a sudden your project's dead. And you don't have to worry about the developers being like, well, I guess this project's not going anywhere, and just walking off with the remaining funds. And you don't have all the politics over who should manage the funds, what they should be spent on. Should they be spent now, or should we ration out over years? It gets very messy when you have a large pool of money in one spot for people to try to figure out what to do with. With our delegate system, you have 101 people, and all the members of the community are working together. There's a little bit of politics involved. Should we hire this person? Are they providing the value? Is this a good marketing effort? But generally speaking, the funds are divided up among enough people that the system can grow, and that the people that are doing good work can cover for the people that might not be producing as much until they can be replaced.
Cool. Sounds like a very exciting potential development there. Because like you said, it provides the long-term sustainable growth model that new ideas and new products need. So that's awesome. Dan, thank you so much for joining us. Really appreciate it. I hope to catch up again with you soon.
Thank you very much, Max.